Hi, I'm Dr. Charlie Peterson. I'm the author of Dude, Where's My Profit? The Accounting Finally Makes Sense mini-course. This is the fourth in a series of videos wrapping up the accounting cycle process. Video number 1 dealt with the daily transactions to the trial balance. Video number 2 dealt with the adjusting and correcting transactions to the adjusted trial balance. And video number 3 dealt with the preparation of the 3 financial statements, the income statement, statement of changes, and balance sheet from the adjusted trial balance. Now we need to prepare the accounts for the new accounting period. Even though we have done a statement of changes, the retained earnings statement, as you can notice, has not been updated yet. This figure should be 920, and we'll see how we get that. Now, there are 2 categories of accounts. There are permanent accounts. Permanent accounts appear on the balance sheet and have their balances brought forward to the new accounting period. And then we have temporary accounts. Temporary accounts go back to a zero balance at the end of the accounting period. Think of the date at the top of the income statement. It was only for the month of April 1 through 30th. We need to start May 1st with zero balances in those accounts. Now there are 3 categories of temporary accounts, the ones that go back to a zero balance. I call them the red accounts. The red accounts. Revenue, expense, and dividends. These are all of our temporary accounts. And if you recall, those accounts were used in the statement of changes that we just prepared in video number 3. So let's start out with our service revenue here. So we'll do this one first. Now, ask yourself, what do I have to do to make service revenue a zero balance? Well, what you need to do is you need to enter the balance on the opposite side, in this case the debit side, and you'll notice that they cancel each other out so that you have a balance of zero here. Now, as you know, every single transaction requires a debit and a credit. So what we're going to do, we've debited this, so we're going to credit retained earnings for $13.40, which enters the revenue on the increase side of retained earnings. So that takes care of the revenue. All right, let's work on the expenses next. Now you'll notice each of the expense accounts has a debit balance, don't they? Now to make them a zero balance, like you did with revenue, you're going to credit the balance. You're going to credit the balance, and so let's go right across the list and do that. To make this a zero balance, we credit this for $500. Gives us a balance of 0. We credit this for $40. Gives us a balance of 0. We credit this for $180. Gives us a balance of 0. Let's say $180. Balance of 0. Adds expenses credited for $40. Balance of 0. Supplies expenses credited for $130. Balance of 0. And rent expenses credited for $200, which gives them all a balance of 0. Now these are all credits. So we're going to make a compound entry and enter the number on the debit side of retained earnings. So we're going to add up all of our expenses, and you can see from the income statement it came out to be $1,090. So we've now credited $1,090. We're going to debit retained earnings for $1,090. All right. So now what we've done is we've closed out the revenue and the expense accounts. Now they're both at zero balances, and we've transferred the numbers. This represents the revenue. This represents the expenses. Now, when you combine these 2 numbers together, you'll discover that what you've done is transferred the net income into the retained earnings like you did in the statement of changes. So this has added the $250 to retained earnings, which is the net income. All right, now we got one more temporary account to go. That's our dividends account. Dividends is a contra account. It's a contra stockholders equity account. It takes away from retained earnings. So dividends, to make this a zero balance, we're going to credit this for $30. B 0, we got a credit, we need a corresponding debit, and that'll put the $30 over onto the decrease side of retained earnings. Now let's rebalance this account, and you'll discover when we rebalance the account, it comes out to be $920, which is what we determined on the statement of changes, $920. So this is retained earnings at the beginning of the period, plus our net income, minus our dividends, gives us retained earnings at the end of the period. Now that we have all the accounts up to date in the ledger, let's do our post or after closing trial balance. What we're simply going to do is transfer the remaining balances from the open accounts right onto our trial balance, post-closing trial balance form. Now, you'll notice that the assets and liabilities, but there's been no change whatsoever in those accounts, so we'll just bring those balances over. Here's my cash at $410. Accounts receivable is $480. Supplies is $90. Equipment is $5,600. Accumulated depreciation now is $1,500. Notes payable is still $1,000. This one up here, accounts payable is $160. Retained earnings is $700. Let's get that over here. Nope, it's not $700. We now have a new figure for retained earnings, which is $920. And capital stock is going to be brought over as $3,000. Now, the reason there's no transfer here is because all of these accounts, your revenue, your expenses, and your dividends, now are at a zero balance. So these are the only accounts that appear in the post-closing trial balance. So if you add those two up, they should be equal, and they are. $65.80 on the debit side, $65.80 on the credit side. So with the four videos, we've gone through the complete accounting cycle process. For video number 1, basically we transferred the daily transactions onto your trial balance page. Video number 2, adjustments and corrections, transferred onto the adjusted trial balance page. Video number 3, we used the adjusted trial balance to prepare the income statement, statement of changes, and the balance sheet. And video number 4, we went through the closing process, closing out our temporary accounts, our red accounts, revenue, expense, and dividends, and updating the net income by adding updating the retained earnings by adding the net income and subtracting the dividends. The accounting cycle is now complete. These numbers here will be brought forward to become beginning balances as of May 1st for our next cycle beginning. All right? Please go to my website, www.dudeworthmyprofit.com, to view additional videos, and thank you for